Hello viewers, welcome to my channel. I am Hashim Ali Khan. Presently we are discussing the subject financial accounting. In this financial accounting, the topic is final accounts of sole trading concern. I have uploaded the video on theory regarding how to prepare the trading profit and loss account and balance sheet, and what are the adjustments we require in preparing trading profit and loss account and balance sheet. So I have prepared a complete video on this introduction to final accounts. So hope my regular viewers have already watched it. The new viewers, first time those who are watching my video, I suggest you to go to the playlist, select the subject financial accounting. In that financial accounting one, you will find sole trading concern, final accounts of sole trading concern. Select the video, watch it, and then you come to the problem. Then only you can be able to understand properly. So before starting the problem, I expect my regular viewers to have a hard copy of the problems which I have provided in the link under my description. So already I have completed 13 short problems. We are doing presently short problems. So 13 short problems, miscellaneous problems on regarding the adjustments to be made. After completing these short problems, we'll come to the main problems regarding preparation of trading profit and loss account and balance sheet. So far 13 problems I have completed. Now I am reading out the 14th one. See the 14th problem. The closing stock on 31st December 2013 was rupees 35,000. Closing stock at the end of the year. There was a loss by fire 10,000 rupees in the first week of December 2013. Show how will you deal with this in case of. So how you are going to deal with this loss by fire 10,000 rupees. We are closing the accounts on 31st December 2013. Fire occurred in the first week of December. Now destroying the goods for rupees 10,000. So 10,000 worth of stock was destroyed by fire. Now how will you deal with this adjustment of loss of stock by fire? In three different cases. The first case, stock was not at all insured. That means no insurance policy is taken for loss of stock. Right? First case. Second case, the stock was fully covered by insurance. That means this 10,000 rupees are fully covered by insurance. A policy, insurance policy has been taken. So the business can be able to get fully the amount of loss from the insurance company. Second. Third one, stock was partly covered by insurance and the claim 7,000 rupees was accepted by the insurance company. In the third case, the stock was not fully covered by insurance, partly covered. An insurance company has agreed to pay only 7,000 rupees. Actual loss of stock 10,000, but the insurance company has agreed to pay only 7,000. So these three cases. First case, not at all insured. Second case, fully insured. Third case, partly insured. Under these three cases, what are the journal entries and what is the effect on final accounts? We have to explain. Now, see carefully. You have understood the problem. Now, journal entries. Accidental loss. This loss by fire is called an accidental loss. In this accidental loss, the first entry will be loss by fire account data to trading account. Remember this entry. Whenever there is an accidental loss of stock, entry will be loss by fire account data to trading account. So trading account credit side, we should take loss by fire. So the above entry is passed irrespective of the fact whether the goods were insured or not. This entry will be a compulsory entry, first entry when the goods are destroyed by fire, irrespective whether it is insured or not. We'll see afterwards whether it is insured or not. But first of all, when 10,000 rupees of stock were destroyed by fire, entry will be loss by fire account data to trading account. Now, the trading account is credited with the value of goods in order to find out the gross profit. If the goods had not been destroyed, they would have been included in the closing stock. See, what is the purpose? Why we are taking it on the credit side of trading account? The reason is in order to find out the gross profit. Because it is an abnormal loss, something accidental loss. If there is no loss, no such loss, then this stock would have been there in the closing stock. If there was no fire, then this stock would have been in the closing stock. So closing stock, we take it on the credit side of trading account. So here also will this loss by fire will also be taken on the credit side of trading account. The actual loss, if the goods had been destroyed, they would have been included in the closing stock. The actual loss depends on whether the goods are insured or not. The actual loss we have to see only after seeing whether the goods are insured or not. So first of all, whenever there is loss of stock by fire, the first entry is loss by fire account data to trading account. Compulsorily, irrespective whether the stock is insured or not. Right? Now we'll take one by one. Case A. Case A, stock was not at all insured. That means no insurance policy was taken. It's a dead loss to the business. It's a complete loss. The business has not taken an insurance policy. The goods of 10,000 rupees were lost. So all 10,000 rupees is the loss to the business. So entry will be profit and loss account data to loss by fire. In the first entry, we have debited loss by fire. Now we are crediting loss by fire. The loss by fire account will get closed. Loss by fire account will get closed. We have transferred it to profit and loss account. The profit and loss account debit side, loss by fire 10,000. The effect, loss by fire will be taken to the credit of trading account. See here, every adjustment we have two impacts. Two accounts will be affected. The loss by fire, first of all, we are taking on the credit side of trading account. Secondly, loss by fire will be taken on the debit side of profit and loss account. There will not be any effect in the balance sheet. In this case, if the goods are not at all insured, the effect will be trading account will be credited, profit and loss account will be debited by 10,000. That's it. No effect in the balance sheet in this case. Which case? Where it is not at all insured. Complete 10,000 rupees is a loss to the business. Now second case, stock was fully covered by insurance. It's exactly opposite. Stock was fully covered by insurance. The businessman can be able to recover fully 10,000 rupees from the insurance company. So during the year itself, the company has taken an insurance policy for loss of stock. When loss occurred, the insurance company will reimburse, will repay, will indemnify the business with complete 10,000. Now there is no loss at all to the business. The goods were destroyed and 10,000 rupees they will recover from the insurance company. So entry, insurance company account data to loss by fire. The loss by fire account definitely will be created because we have to close it. But debit will be given to insurance company account. What is the effect? Loss of goods by fire is shown on the credit side of trading account. Credit side of trading account, and amount due from insurance company is shown on the asset side of the balance sheet. When we make the balance sheet, asset side, amount due from insurance company 10,000 rupees. So one effect, trading account credit side by loss by fire. Second effect, balance sheet asset side amount due from insurance company. Nothing should be taken in P&L account because there is no loss. No loss at all. So nothing will be taken in profit and loss account. Third one, case 3. Stock was partly covered by insurance company and claim of 7,000 accepted by insurance company. Third and last case, the stock was partly covered by insurance. The insurance company has agreed to pay 7,000. Actually, total loss to the business was 10,000. Out of 10,000 rupees, 7,000 rupees are agreed to be paid by the insurance company. The net loss to the business is 3,000. Net loss to the business is 3,000. So entry will be insurance company account data are 3,000. Profit and loss account data, insurance company account data are 7,000. Profit and loss account data are 3,000. To loss by fire 10,000. So in every case, loss by fire is credited. Here amount due from insurance company is 7,000. So debited, insurance company account data are 7,000. How much is the net loss to the business? 3,000. That will be debited to profit and loss account. The effect will be loss of goods by fire 10,000 will be taken on the credit side of trading account. Credit side of trading account. Amount of claim not accepted is loss. Amount of claim not accepted by the insurance company is a loss to the business. How much insurance company has not accepted? 3,000. That 3,000 is a net loss to the business. It will be debited to profit and loss account. Debited to profit and loss account. And Insurance company. The insurance company has admitted the claim for rupees 7,000. This 7,000 rupees will be shown on the asset side of the balance sheet. So on the asset side of the balance sheet, we'll write down amount due from insurance company 7,000. That's all. So three impacts are there in this case. The first impact is trading account is credited by 10,000. Second effect, profit and loss account is debited by 3,000. And third effect, balance sheet on asset side we take amount due from insurance company 7,000. That's it. So this is the end of problem number 14. Now I'm starting the next problem, that is problem number 15. Now see the 15th problem. A plant of the book value of 40,000 was disposed of for rupees 14,000. So actually book value of the plant is 40,000 and it is disposed of at rupees 14,000. So there is a loss. 40,000 rupees worth of plant was sold for 14,000. So 40,000 minus 14,000, 26,000 rupees is the loss. In part exchange for a new plant costing 35,000. That means we are not selling for cash. We are exchanging. We are exchanging for a new plant of 35,200 rupees. The cost of the new plant is 35,200. The net invoice of rupees 21,200 was passed through the invoice book. Actually the net price, we are selling the old plant. Book value of the plant was 40,000 and we are exchanging for 14,000. So the cost of the new plant is 35,200. So remaining balance we have to pay in cash. So how much is the balance? 35,200 minus 14,000. You will get 21,200. This 21,200 was passed through purchases book. Actually when plant is purchased, it should not be recorded in invoice book. First mistake. When plant is purchased, it's an asset. It will not be recorded in the invoice book. Invoice book is a purchase book. Purchase book will record only goods purchased, not asset purchased. Here they have committed a mistake. They have taken this in invoice book. 21,200 was taken in the invoice book. Make the necessary adjustments. Now it is asking you to pass the adjustment for rectifying this error. What is that error? 40,000 rupees worth of plant was sold for 14,000 in exchange for a new plant of 35,200. The new plant cost 35,200. 35,200 new plant, right? So, and the difference between this 14,000 and 35,200, 21,200 was passed through purchases book. That is a mistake. Now we have to rectify. How to rectify? Here I am explaining. Exchange of an old asset with new and the difference regarded as purchases. Now in 3 steps we are going to find out the working notes. The first working note, loss on sale of old plant. The book value of the plant sold was 40,000. Less exchange value agreed is 14,000. So 40,000 minus 14,000, 26,000 is the loss on sale debited to profit and loss account. This loss on sale of plant 26,000 should be debited to profit and loss account. The P&L account debit side, loss on sale of plant 26,000. Purchase account was wrongly debited with 21,200. It's not a purchase. It is given that the difference 21,200 was passed through invoice book. Invoice book means purchase book. So by mistake purchase account was debited. Now we credit purchase account. We credit purchase account by 21,200. Next one, new plant purchase should be debited with 35,200. New plant purchased is 35,200. This will be debited. And the plant sold should be credited with book value. The plant sold should be credited with book value. What is the book value of the new old plant? 40,000. So 40,000 should be credited. The new plant 35,200 should be debited and the old plant 40,000 should be credited. So adjustment entry will be like this. Plant new plant 35,200 should be debited. And the loss 26,000 rupees loss should be debited to profit and loss account. The new plant 35,200 should be debited and profit and loss account loss is 26,000 debited. 2. Plant old. The old plant should be credited with the book value. Credited with the Book value. The book value of the plant is 40,000. Then 2, purchases. Purchase account, by mistake we have debited. By mistake purchase account was debited. Now purchase account will be credited by 21,200. 21,200. This is the adjustment entry for exchange of old plant with a new plant and rectifying the error that it was debited to purchase account. Now we have created. That's all. This is the end of problem number 15. Now see the problem number 16. 16th problem. Included in the sales were sales of goods of rupees 10,000 or sale or return basis, for which the consent of the customer was not received up to 31st December 2013, the day on which accounts are closed. Goods sold included profit of 25% on cost. Make the necessary adjustment. See, included in sales are sales made on approval or return basis. Sometimes a business will sell the goods on approval basis. Approval basis means the seller will give the goods to the buyer on the condition that you approve it and then we treat it as sales. Till the time he has not approved, it should not be treated as sales. Suppose I am the seller, you are the buyer. I am giving you the goods on approval basis, sale or return basis. Sale or return means you give your opinion. If you want to retain it, we'll treat it as sales. If you don't want to retain it, return back to me. That is called sale or return basis. So when the goods are sold on sale or return basis, it should not be treated as actual sales until and unless the contention of the buyer is received. Until the buyer has given the contention, we should not treat it as sales. But here what had happened? The business has treated that as actual sales. 10,000 rupees goods are given on sale or return basis, and that 10,000 rupees was recorded as actual sale. That is a mistake. That is a mistake. So we have to rectify the error. And also the sales include a profit of 25% on cost price. Now, how to rectify it? See here, goods sold on sale or return basis but wrongly treated as sales. Goods are sold on sale or return basis, but it is wrongly treated as actual sales. When goods are sold on approval or sale or return basis, these goods should not be treated as actual sales unless customer informs his intention of retaining the goods. जब तक के कस्टमर रिटेन करने का इंफॉर्मेशन नहीं दिया तब तक वो गुड्स को सेल ट्रीट नहीं करना. We should not treat it as sales, right? To rectify the mistake of treating such sales as actual sales, the following adjustment entries should be passed. Now we want to rectify. The business has treated it as actual sales. It is not an actual sales. So adjustment entry will be sales account data to customer's account. We will reverse. What is the correct entry when we sell the goods? Customer account data to sales account. This is the entry when we sell the goods to the customer. Now we want to reverse the entry. It is not a sale. It is not a sale, actual sale. So we will reverse it. Sales account data to customer's account. Being the sales cancelled. By passing this entry, the sales will get cancelled. The effect of this entry is sales in trading account will be reduced. By debiting sales account, the total sales will get reduced on trading account credit side. And the sundry debtors in balance sheet will also be reduced. So two have twice effect. One effect is the sales will get reduced on the credit side of trading account. Secondly, the debtors on the asset side. On the asset side of the balance sheet, debtors will get reduced. This is the impact of this entry. And I reverse the sales. Now, the next effect. The next effect is, but the goods sold on approval basis should be treated as stock. When goods are sold on approval basis, it is not treated as sales. We have cancelled it. But the goods are lying in the hands of the customer. That is a stock. So we have to treat it that stock on approval. That we treat it as stock on approval, right? So the value of closing stock both in trading account and also in balance sheet should be increased. Such stock should be taken at cost price. So whatever is the stock lying at the customer's hands on approval basis, that stock should be valued at cost price. Actually 10,000 rupees worth of goods were sold to the customer. Now we have to find out what is the cost price of that 10,000 rupees. And for that we have to pass the entry. The entry is stock on approval account data to trading account. Stock on approval account data to trading account. This entry will be passed for the goods lying with the customer and the customer has not given the approval that he wants to purchase it or not. He has not given the approval. The cost price. How to find out the cost price? The sale price is given as 10,000 rupees. And when information is given, goods sold included a profit of 25% of cost. This point is given in the problem. Goods are sold at a profit of 25% on cost. So let the cost be 100. Suppose cost is 100. The profit is 25% on cost. So 25% of 200 rupees. 25% of 100 rupees, 25 rupees. तो cost price अगर 100 rupees है तो profit 25 rupees हो तो selling price will become 125. Cost plus profit is equal to sale price. When cost is 100, profit is 25, sale price is 125. What is the actual sale price given in the problem? 10,000. For 10,000 actual sale price, how much would be the cost? So 10,000 divided by 125 into 100, you will get 8,000. So the cost price of the goods lying in the hands of the customer for approval is 8,000. So entry will be stock on approval account data to trading account. That's all. So these are the adjustments we have to make when goods are sold on sale or approval basis or sale or return basis. That's it. So this is the end of problem number 16. Come on, now I am starting the 17th problem. 17th problem, you see carefully. Closing stock includes goods worth rupees 5,800 for which bills had been received and accounted for in the books. Bills had not been received and accounted for in the books. Make the necessary adjustment entry. Closing stock includes goods worth rupees 5,800. That means we have purchased the goods and the goods are included in the closing stock. But the bills had not been received and accounted for. So far bills have not been received, but goods have been received. When goods are received and included in closing stock, but the entry has not been made. So now we'll make the entry. So in this case, goods received but not recorded in the books. So adjustment entry, purchase account data to creditors, normal entry. Whenever we purchase the goods, the entry will be purchase account data to creditors. So here 5,800 rupees being the goods purchased included in the stock but not recorded in the books. So now entry is passed. Goods are received included in the stock but no entry has been passed. Now we pass the entry purchase account data to creditors. What is the effect of this entry? Add to purchase and trading account. After passing this entry, we have to add this amount to purchases on debit side of trading account. Similarly, add to creditors on the liability side of the balance sheet. On the balance sheet, liability side will have creditors. To that creditors, we add 5,800. So simply 5,800 should be added to purchases on debit side of trading account and 5,800 add to creditors on liability side of the balance sheet. That's all. This is the problem number 17. Now last and final short problem is 18th problem. See carefully. Machinery sold during the year rupees 5,800 has been credited to sales account. So actually when machine is sold, the entry will be cash account data to machinery account. Because it is an asset, sales account will be credited only when goods are sold. Here goods are not sold, machinery is sold. By mistake, it is credited to sales account. Machinery sold during the year 5,800 had been credited to sales account. Now we debit sales account. By mistake we have credited to sales account. So to rectify that we debit the sales account by 5,800. And the machinery account stood in the books at 8,000. That means the book value of the machinery was 8,000 and it is sold at 5,800. That means there is a loss of 2,200. 8,000 rupees worth of machinery was sold for 5,800. So there is a loss of 2200. Make the necessary adjustment entry. See here. First of all, the book value of the machinery was 8,000 and it is sold at 5,800. So 2,200 is the loss on sale of machinery. Secondly, when machine is sold, machinery account should have been credited, but by mistake sales account was created. So to rectify that, we debit machinery account and credit debit sales account and credit machinery account. Here journal entries: sales account data to machinery account. By mistake we have credited sales account. Now to rectify, we debit the sales account. And actually which account should have been credited? Machinery account should have been credited when we sell the machine. When we sell the machine, machinery account should have been credited. It was not credited. So now I am crediting. Now I am crediting machinery account. So to rectify that, sales account data to machinery account 5,800, being rectification entry for treating the sale of machinery, as sales. This is the first entry. Secondly, there is a loss, 2,200 rupees is a loss because the book value of the machine was 8,000 and it is sold at 5,800. So there is a loss of 2,200. The entry for loss is loss on sale of machinery account data to machinery account, 2,200, being the loss on sale of machinery. Now finally, this loss on sale of machinery should be transferred to profit and loss account. Loss on sale of machinery we have debited. Now we credit loss on sale of machinery and transfer this amount to profit and loss account debit side. So entry will be profit and loss account data to loss on sale of machinery 2,200, being the loss on sale of machinery transferred to P&L account. That's it. Totally 18 short problems we have completed on final accounts. These short problems are all adjustment problems and a special items which will occur while doing the long problems. In the next video, I am going to start the main problems on final accounts, that is trading, profit and loss account and balance sheet. In those problems, one of the peculiar adjustment that may arise are these one. What we have done in the short problems, 18 short problems. So hope you have understood the adjustments what I have done in the short problems. In the next video, I am going to start the main problems on final accounts of sole trading concerns. If you are satisfied with my lecture, give a like to the video. Subscribe my channel if you have not subscribed. Give your comments and share it in your groups, in your friends, so that more students can get the benefit from this lecture. See you again in the next video on the main problems on final accounts.